Warm welcome to all our partners, Team Motilal Oswal, and my dear colleagues. We have a very interesting guest with us today. He have achieved many milestones at a young age. He is very inspiring. He is a dynamic personality. Let's welcome Mr. Atul Mehra. So I would like to give you all a brief introduction about him. Academically, Atul is a CFA, charter holder from a CFA institute, USA, which stands for Integrity, Ethics, and Competence, and understand the purpose of finance is to understand wealth, well-being for the society. He's extremely passionate about the market and has been investing since he was 13. He has invested, he is having a great experience over 22 years and professional work experience over 15 years, less than 10 years with Motilal Oswal and 5 years with the Edelweiss Capital. So I think let's have a promising session with him and let's see his views towards the market as well as the large caps. So over to you, Mr. Atul. Thank you.
Thank you, Disha, for the very warm in terms of introduction. I thank you everyone for your time today evening. We will be talking about Motilal Oswal Large Cap Fund NFO, which has already opened on the 17th of Jan and it closes on the 31st of Jan. So while we talk about the presentation, we'll be talking about it in three parts. First is why large caps, second is why large caps make sense now, and third is why look at Motilal Oswal Large Cap Fund in this space. So to begin with, in terms of what are large caps, so as per the SEBI categorization, the top 100 companies by market cap are the large cap companies. So today the range of market cap for these top 100 companies is 69,000 crores to 18 lakh crores. Next 150 is mid cap and next 250 and beyond is the small cap universe. Now, why large cap? So if you look at the significance of large cap, the top 100 companies, they contribute 35% to our GDP, 65% of all listed company revenues comes from the Indian top 100 large cap companies. 74% of all listed companies profit. So of the 136 billion profit, over 100 billion comes from the top 100 companies, which is 74% of the overall listed company universe. And in terms of market cap, about 64% of the total market cap that we have in our country comes from the large cap space. So if you look at it, India is equal to India's large caps and they are significant contributors in every respect. Now, as India is moving up the rank in terms of global GDP, so India was the 9th largest economy in 2010. We were the 6th largest economy in 2020. And today we will in 2030 we believe we will be the 3rd largest economy. So as India moves up the GDP rank, you will see many Indians contribute to being the largest companies globally. So in the global large cap universe of 100 companies, there are just 3 Indian companies today: Reliance, TCS, and HDFC Bank. And we believe that there are many more in the making. As India grows, even Indian companies will become large in the global aspect. In fact, another way to look at it is our largest company, Reliance, it has a global rank of 55 in terms of market cap. And our smallest large cap company has a global rank of 2,140. So Indian large caps are mid and small cap in a global context. Actually, if you look at it, the largest company, Apple, has a $3 trillion market cap. And India as a country has $3.8 trillion market cap. So just imagine the change, like the quantum of difference, like one company and one country having almost like similar market caps. So that is the opportunity that we see from a longer term perspective in India. Now, what is the track record of large caps? So if you look at it over the last 21 years, the large cap index, Nifty 100 total return index, it has grown from 1,000 to 29,000, which is 17.4% CAGR in the last 21 years. And we want to talk to you about an interesting concept of owner versus loaner. So if you're an owner in a business, you have been able to derive 17.5% CAGR in the last 21 years. And as against a fixed income loaner, basically, where you are getting 7% fixed deposit return. Here, if you look at it, 85% of the time on rolling return basis, the large Indian companies have beaten the 7% benchmark 85% of the time on rolling return basis and 89% of the times on SIP basis on a 5-year rolling basis. And on 7-year basis, if you were to look at it, 98% of the times Indian large caps have beaten fixed income benchmark. 10-year basis, either SIP or lump sum, 99% of the times large companies have beaten the fixed income benchmark. So another way to look at it is over the last 21 years, money would have been multiplied by 29 times investing in the top Indian companies. versus only 4 times at the 7% hurdle rate of a fixed income. And inflation at the same time has grown by about 3x. So if you look at adjusting for inflation, purchasing power growth, large Indian companies have grown their purchasing power by 9 times in the last 21 years. And fixed income pre-tax is 1.2 times, post-tax it is less than 1 time, because the after-tax rate of return on fixed income has been lower than the inflation rate over the last 20 years. So what we're trying to say here is, if you are having excess allocation in fixed income, some bit of necessary allocation is absolutely required as part of a portfolio in fixed income. But in the name of safety, a lot of people have a lot of money in fixed income. So from that perspective, we believe large caps are a good alternate if you have the long-term mindset and purchasing. Basically, if you have the long-term mindset as well as time horizon on your side. Now, if you look at large versus mid and small in terms of drawdowns, you'll see that in 2008, large caps declined by 61% when mid and small caps declined by 75%. Similarly, in 2018 to 21, large caps declined by 38 when mid and small caps declined by 52%. So whenever large caps in the past have declined, they've declined less than mid and small. And the second thing is the recovery period has been faster for large cap versus mid and small cap. So large caps came back to the previous high in 34 months in 2008, when mid and small caps took 78 months to come back to the previous high. Similarly, in 2018 to 21, large caps took 10 months to come back to the previous high versus 37 months, about more than 3 years that mid and small caps took. So what we are trying to say here is, historically, large caps have had lower drawdowns and have recovered faster versus small and mid caps. So that is the section where we spoke about the significance of large caps and why one should look at large cap as an allocation in a portfolio. The second question we want to answer is why large caps make sense now. So if you look at it, we have done a price ratio analysis for the last 20 years since the time data is available. So large cap Nifty 100 index divided by mid cap index, small cap index, micro cap index. So if you look at the relative price performance, large caps today are trading at the lowest point in their 20-year history versus mid and small and micro. Additionally, if you look at this slide, you'll see that the return on equity of large caps is the highest, and the P multiple, the price that you're paying, is the lowest versus mid and small cap. That is the in terms of scenario where large caps are offering the highest quality and available at the lowest valuations versus mid and small cap. Additionally, in the last 5 years, you've seen that the proportion of market share of large caps in total sales has grown from 65 to 66%, and in total profits has grown from 73 to 74%, while the share in total market cap has declined from 72 to 64. So what has happened is, while profitability has also been strong and sales has been strong, the price performance of mid and small caps has been faster in the last 12 to 24 months time. And hence the market cap share for large caps has come down. Now, what is the reason for this? In our opinion, the key reason for this is FIIs have been net sellers for the last 3 years. Cumulatively, FIIs have sold 50,000 crore of equities in the last 3 years. And 80% of all FII money in India is in large caps. So whenever they sell large caps. And at the same time, domestic investors have bought 6 lakh crores of equity. But if you look at the profile of flows that we've had in mutual funds in the last 12 months, we have had 1,50,000 crores of inflow in the mutual fund categories, in mutual fund in India, in equity category. Now, of the 1,50,000 crores, 40,000 crores has come in small cap, 23,000 crores in mid cap, and large cap has seen 2,700 crores of outflow. So FIIs have been sellers, and when they sell large caps because all they own is large caps. Domestics have been buyers, but what they buy is mid and small because that is where they have seen flows. And the third angle to the equation is, if you look at it in terms of direct investors in India, now last month we crossed 14 crore demat accounts. So whenever we are seeing that new demat accounts being opened, that money, a lot of it is going towards mid and small cap and not large cap. So again, you are seeing a very different in terms of behavior. So that has been the key reason, in our opinion, why large caps have not done as well so far versus mid and small cap. But what will change this? So in our opinion, the reason why large caps will again do well this calendar year is led by FII flows. So we believe that after the election result, you will see India allocations go up, and hence you will see FIIs come in the market in a big way. Every 1% ownership in India is $40 billion in flows. So even if FIIs have to come back to the previous average of 21.2, that is about $60 billion of potential flows. And 60 billion in INR terms is over 5 lakh crores. So if they have to come back to the previous high of 23%, they need to put about $120 billion to work, which is over 10 lakh crores in terms of Indian flows. So we believe that there is large flow expected from FIIs after the election result, and hence you will see Indian large caps do well as we see an outcome on that particular count. So that is the thinking on why large cap now. Now the third question we want to answer is why Motilal Oswal large cap fund. So if you look at the large cap fund category, there are 30 funds who already exist in the category. They manage 2,80,000 crores of assets. And but the peculiar part is of the 30 funds, the top 10 funds, they manage over 2,60,000 crores assets. So which means over 90% of the industry AUM is with the 10 funds, top 10 funds. The largest fund in the category manages 50,000 crores of equity money. So if you look at it from that perspective, a lot of money is with the top funds. Now, asset size tends to be a reason why index, funds tend to become more like closed indexes, and that is exactly what we see in the data. So the positioning that we have, the framework that we have for running the fund is basically high active share, high conviction, equal weight portfolio. So if you look at it, the existing high active share component, you'll see that the index itself has a 0% active share because it is 100% passive and a replica of the index. If you look at the peers, top 10 peers, which manage over 95% of the AUM, their average active share is 40%, which means 60% of the portfolio is common as the benchmark. At Motilal or large cap fund, we want to run a fund with minimum 60% active share. So that way, we will be very in terms of different than the index and the peers in terms of our portfolio. So that is point number one. Second is in terms of conviction. As a house, we are known for our DNA, which is high conviction. So the index has 100 stocks. The top 10 peers have 58 stocks. We want to run a 30 stock portfolio. The third is if you look at the index, it is very top heavy. So if you look at this particular slide, you'll see that the top weight in the index is 11.5, top 3 is 25, and top 10 is 50%. So in a 100 stock index, 50% of the money is with the top companies, top 10 companies, and balance 50% is with the 90 companies. So it is extremely top heavy. So that makes the index very, very susceptible to the performance of the large companies in the index. And we believe that is not the right way to go about investing. Investing has to be where you have to allocate money to the best available opportunities across sectors and across styles. And hence, we believe that a 30 stock equal weight portfolio, where each company is allocated 3.3% weight to the portfolio, will bring both the components that we desire, which is high conviction and balanced diversification. So our goal in running the fund is consistent outperformance. So outperformance should come from high active share and high conviction, and consistency should come from being equal weight in terms of approach, and also in terms of having a balance in terms of sector weights, having a balance in terms of styles. So that should drive the consistency aspect that we desire. So that is how we are going to be extremely different and unique versus any other fund in the market that is available in the large cap space. Now, if you look at there's this general popular perception that there is no alpha in large cap. So what we did was we did a study for the last 20 years, and where we are looking at the 25 best performers within the Nifty 100 index. And what we saw was the top quartile performers in the Nifty 100 gave you a 75% return in the last 20 years versus 16% for the benchmark, which is an alpha potential about 59%. So there is alpha available in the market in the large cap space. Additionally, within sectors, if you look at it, the best performing power stock in 2023 calendar year gave you 87% return versus minus 60% for the worst performing stock, which again means that there is 150% dispersion within the power sector. Additionally, if you look at it, every other sector, oil and gas, consumer, capital goods, there is similar level of dispersion of 80 to 100%. So we believe that true active management is about picking superior businesses and stocks within sector, within styles, and having an appropriate allocation methodology versus being very, very top heavy. So if you look at equal weight by itself on a passive basis, also has done well on a last 21 years since the time the index has begun. Equal weight is up 37x versus 29x for the index. And even globally, it's a similar experience. The S&P 500 US stock market equal weight index has done better than the market cap weighted index. And we believe that in terms of that is the kind of philosophy we believe should help us on the allocation side while running the fund. So the construct for us is basically of the 100 companies, we want to identify 25 companies, minimum 80% of the fund has to be in the large caps as per the large cap fund mandate. So 83%, so 25 to 3.3, that's 83% of the fund for us will be in the top 100 names. And here we aim to identify the top quartile performers from various sectors and various styles and have them allocated in the portfolio. And balance 15 to 20%. Here we have the full flexibility to invest in mid and small cap names which we believe are potential multi-baggers. Additionally, we also want to invest in IPOs and pre-IPO names. So I want to qualify one particular element here. So typically, like, size is the enemy of fund management on the alpha side, and we believe that as a new fund offer in this space, say if we are able to generate about 1,500 crores of AUM. So if you get a 30 crore allocation in an IPO on a 1,500 crore AUM, you get 2% of the fund invested in the new IPO. The IPO is opening 50% higher, then you get 1% alpha at the fund level. So as against that, the largest fund in the category is having 50,000 crores AUM. So if you have a 30 crore allocation in a 50,000 crore AUM, it doesn't move the needle in terms of return. So we believe that small fund size, additionally, with the focus on looking at interesting IPOs, the pipeline for IPOs is very strong in the next 12 months. So we believe that combination of AUM and focus on IPOs should help us driving alpha on the balance 20% of the fund. Additionally, some of the AMCs like us, we have a arrangement where we can do pre-IPOs as well. So whenever a company has filed its DRHP with SEBI, after that we can get an allocation in the pre-IPO stage for a company. So that again helps us in getting larger allocations, and the lock-in periods for pre-IPO today are about 6 months or 3 months for IPO anchor. So that again is an advantage for us. Foreign equity is also available, but at this point in time, given the fact that RBI has restricted it, we are not able to allocate to foreign equity. But in the future, whenever things open up, we will be open to looking at foreign equity as well. So there's a combination that we want to drive a 30 stock portfolio with high active share, high conviction, equal weight. In terms of stock picking philosophy, like the learning for me over the years in terms of markets has been that what Phil Fisher said 60 years back, in evaluating common stock, management is 90%, industry is 9%, all other factors are 1%. So if you look at the global experience, Apple without Steve Jobs or Berkshire without Warren Buffett, they would not be the companies and the kind of wealth creation that has happened. Similarly, in India, if you look at it over the years, there were a number of licensees at the time. HDFC Bank got the license, but HDFC Bank under Mr. Puri created the highest amount of wealth. More lately, if you look at DMart and its evolution in the retailing space, we believe Damaniji has a very large role to play in the success of DMart. Again, like in the more recent years, Velan from the Murgappa group, I think whatever he has touched has generally turned gold, right from Chola Finance, which was a 20 bagger, to Tube, which has been a 15 bagger, to CG Power in 2020, which has been a 100 bagger. So similarly, if you look at Chandra, since the time Chandra became the chairman of the Tata Sons group, a lot of Tata companies have seen a tremendous change in their fortunes, and we believe it has come from some perspective from Chandra and his leadership in leading the group. So across the board, great managers create great businesses, and stock picking begins with identifying great managers. So we want to invest in great managers, great business, and have them in their portfolio where there is high margin of safety available. So that is a quadrant we would ideally want to be in, which is the highest return quadrant. In terms of fund manager track record, so I think like Disha spoke about, my journey in markets began very early at 13 years of age, and for the first few years I was involved in terms of the markets with the family and so on. But by the time I was graduating in 2008, from 2001 to 2008, the market was up by 8x. The Sensex after 9/11, when I entered the market, was 2,500, and by 2008 it was 21,000. So by the time I was graduating, I was fairly clear this is the space I want to be in, and I got placed with Edelweiss Capital at campus, and I worked with Edelweiss for over 5.5 years. I pursued the CFA charter while working with Edelweiss. I've been a charter holder since 2012. 2013 is when I joined Motilal Oswal. It's been over 10 years with Motilal Oswal now. Before moving to the mutual fund, basically I was managing funds on the alternate side, PMS and AIF. So about 3,500 crores of capital is what I was managing on the alternate side. If you look at it, this has been the track record for the funds. Most of the funds were flexi cap in nature, with Nifty 500 being the benchmark. So 65% of the portfolio was large cap, 35% mid and small cap, Since the time I became a portfolio manager, I collapsed my personal portfolio and I put all my money and my family money in the funds that I was managing on the PMS and AIF side. And now that I'm making the move to the mutual fund, I'm moving most of this money to the mutual fund that I will be managing myself. So I've already given the redemptions for AIF and putting that money in the mutual fund that I'm managing. So these have been some of the key winners for me. Safari has been up 8x in the last 3 years. Phoenix 4x, L&T Infotech 4x, Gokulda exports about close to 3x. So that has been the kind of returns that some of the biggest winners in the portfolio have created. In terms of sponsor oversight and skin in the game, so Ramdevji is our chairman and mentor, and Naveen is our CIO. Naveen is our CEO. Pratik is our CIO, and basically we have over 5,000 crores of our own money in our products. So we have significant skin in the game from the fund manager as well as from the sponsor. Even in the NFO of large cap, we will be putting over 100 crores of our capital in the NFO. So that is the level of belief and skin in the game that we have in our own products. Broadly, I think we covered most aspects. I thank you very much for the patient listening, and we are now open to any Q&A that we might have. Thank you very much. Disha, you're on mute.
Yeah, thank you. Thank you so much, Atul, for the wonderful brief, not just about the market outlook, also about the large caps that we are very well focused for the day. And thank you so much once again for the wonderful presentation. So yeah, just for the sake of mentioning to all my partners that the NFO have already started from 17th Jan and ending on 31st Jan. So please do support for the same. And I'm sure all my partners have taken their takeaways from this amazing presentation. So let's open a floor for Q&A. So here I will present you the first question. I'll read out for you. So just a minute. Yeah, so here is the first question.
Yeah.
If an aggressive investor is investing lump sum with a 3 years horizon, which three schemes will you recommend from your AMC? And should he invest lump sum or use the STP option, systematic transfer plan?
So there's this great author Taleb. He says that don't ask me what you will do. Show me your portfolio. So I'll also show you my portfolio. So my portfolio is very simple. I put all my money in the funds that I manage myself. So over 99% of the money will be in the funds that I manage myself. So earlier they were part of like the PMS and AIF products that I was managing, and now that money will be in the large cap fund that I will be managing. So I can only tell you what I have been doing. Obviously, maybe some of my colleagues can also talk about the other funds and other schemes, but maybe we can park that question for later.
Sure, sure.
And the second thing in terms of lump sum or STPC, basically it depends on asset allocation. So somebody who is moving money from one product to another, where there's a switch happening, then lump sum makes sense. Like when I'm moving my money from AIF to mutual fund, it is a lump sum because I want that money to stay in equity because it's part of my equity allocation, right? But somebody who's putting new money to work and fresh money to work, and then there is a lump sum. So in that case, maybe you can consider STP as a better option or SIP as a better option. But if you're moving money from one large cap fund or from one product to another, you can look at lump sum from that perspective.
Sure. Thank you so much. So we'll move to the other question. This is an interesting one. Many investors believe that the large cap category may do well as the market is entering into the expensive territory. According to you, what is the right time to invest and how long one should stay invested in large caps? I think you have covered partially in your presentation, which I have heard from it is that only that this is not the large caps are still undervalued. So it's a good time to buy. So just give the clarity over the thing.
Yes, so I would say that broadly markets are around long-term averages. So I won't think that it's very expensive. So if you look at Nifty itself, next year expected earnings is about 1100 and it's about 21,500. So we are almost like close to 20 times earnings multiple, slightly lower than that. So broadly, you're fine. And the key is that long-term returns depend more from earnings growth from a long-term perspective, which we are confident on at this point in time. So you will see that in the long term, if you have a 5-year, 10-year horizon, your returns will be more correlated to the earnings growth of the company and the market, and that outlook for that remains strong at this point in time. So we believe that you should stay invested for minimum 5 years if you're investing in a product on equity, and
Sure.
you should expect returns which should be more or less similar to earnings growth profile of the market.
Okay. Thank you for the precise answer. Yeah, we'll move to next. Yeah, this is related to the budget. How budget will impact on large cap space?
So the budget is this time a vote on account budget, which basically means from 1st of Feb till the time that we have elections, which is mid of June, right?
Yes.
So it is a budget only for that duration. So even the finance minister has said that there is nothing that is expected in the budget because a vote on account budget rarely talks about anything very significant. So we would believe that the budget is a non-event, and it's most likely it's a neutral to non-event person.
Okay. Yeah. Thank you. Yeah. So my other question to you is every other AMC have a large caps way back. Why Motilal Oswal have come up at this point in time?
So overall, as an AMC, we have been on our expansion phase in terms of launching newer products and uh, expanding our product bouquet. So initially, when we started the mutual fund, we thought of initial phase being just focused on 3 products, and then over a period of time, we have thought of expanding across categories. So that has been the thought process, and we believe at this point in time, the large cap space also looks fairly attractive versus the rest of the market, and hence from a timing perspective, we believe the large cap NFO is timed well, and taking into account the fact that election is around the corner and we might see large flows from FIIs post election. So we think that the timing for the large cap offering is fairly reasonable at this point in time.
Correct. Correct. Thank you. Perfect. Uh, we'll move to the last question. What should be the percentage allocation given in one's portfolio for large cap funds?
So, so actually, it depends on multiple things because allocation is more individualistic in terms of nature. So, for example, your own the investors' age profile, financial background, other sources of income, and so on and so forth. So, it's more a function of in terms of it's more like personal finance is more personal than finance. So, from that perspective, it depends. But on a general basis, if you were to think of it, large cap can be seen as 30-40% of allocation, which is more like a core allocation to anybody's portfolio. So I would presume if you just generalize it, 30-40% is a good allocation in large cap space.
Good enough. Okay.
Yeah.
Yeah. Thank you so much. So I think we have covered all the major questions that we have received from our partners. So I think it was a wonderful presentation from the learning point of view as well. So thank you, and thank you so much for to entire Motilal EMC team. So I would like to thank everybody. Thank you. It was a
Thank you.
wonderful presentation.
Thank you, Disha, and thank you everyone for your time. Thank you very much.
Thank you. Let's conclude the session. Thank you.